Happy Wednesday, everybody. It's me here with your daily market update. Today's markets pulled back as signs of stubborn inflation collide with retailer price warnings. Let's start looking at some numbers. U.S. markets dipped today, with the S&P 500 dropping about 0.3% as inflation data remains sticky. The Fed's favored PCE inflation gauge held steady at 2.6%, while core PCE ticked up to 2.9% over its 2% target, reinforcing rate cut uncertainty. In other words, the Fed may have to hold rates higher for longer if inflation keeps ticking higher like it did today. No. Story of the day. We have major brands like Hormel Foods, Ace Hardware, and J.M. Smucker warning of price increases driven by rising tariffs on imports. This is an important story because it shows that price increases are starting to hit even more retailers. So far, we've seen Walmart and Target start passing costs to consumers. This is a sign that inflation may be more persistent than expected. Third story of the day. What do markets currently expect? Well, despite inflation, markets still expect a 25 basis point rate cut in September, with traders pricing in an 86 to 87% probability. A rate cut is still priced in for December as well, with a 70% chance. And lastly, the market is pricing in a 65% chance of a rate hike in November. Now let's get into my favorite part of the show, where I look at one chart that summarizes everything. Today, there's a lot to unpack here, so bear with me. This is a treasury yield curve showing short-term yields against long-term yields. Now, when we look at the curve, you can see that it flattened quite dramatically today. But before you start thinking that this is bearish, remember, our friend Jerome Powell is in town. He's going to come to the rescue. Just kidding. But seriously, he has signaled that the Fed will maintain a restrictive monetary policy stance, keeping rates higher for longer. When we look at this chart, we see that long-term yields are beginning to fall relative to short-term yields. In other words, investors are buying long-term bonds and pushing their prices higher. Why are they doing this? Well, it seems that the market is beginning to worry about two things. Will the Fed pivot and cut rates aggressively? And two, are they concerned about sticky inflation? The fact that long-term bond prices are rallying suggests that investors are anticipating lower growth and possibly even recession in the near future. This is because when investors are uncertain about the future, they often flock to safe haven assets, such as government bonds. The lower the expected growth, the higher the demand for bonds, which would cause their prices to rise and yields to fall. So, what does this mean? It means that the bond market is sending a warning sign to stocks. Historically, when bond yields decline and the yield curve inverts, it's been a precursor to economic downturns and lower stock prices. So what should you do? Be cautious and prepared for potential market volatility. All right. And that's why I always say that the bond market is the most efficient market of all. It's telling us that growth expectations are falling and inflation is a concern. Lastly, let's look at market sentiment. The CNN Fear and Greed Index remains in greed territory, suggesting that investors are still optimistic. Despite today's pullback, the index did move towards neutral, indicating some concerns. The VIX, also known as the Fear Index, is also hovering around 14, suggesting that the market is calm. However, it did increase slightly from yesterday, showing some increase in volatility. Overall, markets remain resilient, partly due to the encouragement from the Fed that rates will stay lower for longer. But with the pressure on bond markets and rising costs among retailers, sentiment could change. So, expect volatility as we head into September. And that is why it is super important to get these daily market updates so I can keep you informed about what's really going on in the markets. To sum up, inflation remains elevated. Retailers are signaling cost pressures, yet markets price in rate cuts. Are markets underestimating inflation's impact, or will encouragement from the Fed keep the rally alive? Share your take in the comments below. If you found this helpful, don't forget to subscribe to Profit Path for your daily market briefing. See you back here tomorrow.